Good morning, good afternoon, and good evening. This is Brian Kahn, and we are going to be talking this evening about using moving averages within trending markets. This is a follow-up to a webinar that I hosted 2 weeks ago talking about trending markets, and now we're adding in those moving averages. I'm working on a new website. A lot of people have been asking for that, so you can see that there, jupiterpeakfinancial.com, and if you have any questions, you can email me at bcon1@gmail.com. Let's go ahead and get started. And as always, your questions are welcome. Please type those in as we go throughout the broadcast tonight, and I will try and get those answered as we move along. I'll try and check back to the panel here. First things first, we've got to do our disclaimer. I'll leave this up for a few seconds. And as always, this disclaimer is very important because you're trading foreign currencies, which is a leveraged product, and no matter what product you're trading out there, whether it's leveraged or not, trading plans are a must, as there are no guarantees that anything that you plan will happen. So we want to make sure that we take the necessary steps to make sure that our account survives and we move on to trade another trade and trade another day. An outline of where we're going tonight, just a quick touch on fundamental analysis, your quick catch-up. Then we'll go into trend analysis, where I'll refer to the last webinar where we talked about trends, and then we'll kind of go right into technical analysis. Usually I do fundamental analysis followed by technical analysis, but since trend is a technical analysis tool, we will talk about those live market examples and move into long and short-term opportunities, and then talk a little bit more specifically about moving averages, which ones are for you as a trader. And if you're not sure, then we'll kind of go in and talk about how you can find out a little bit more about what's right for you as an individual trader, where we go into your opportunity. So fundamental analysis, a discussion of current events and what they mean for traders and investors. We know that there's a lot going on each and every day. So to stay on top of that, your broker is providing information. IBFX provides a link right to forexfactory.com, which is a great place to stay on top of the news. CNBC or whatever worldwide television station you use, Bloomberg, that's following the markets. I think that's a great way to stay on top of it. Obviously, there's other market sites that people use. So whatever you're comfortable with that helps you effectively be a good researcher and finding out what's important again to you and the strategies you're trading and the style and length that you are trading. That's really important because there's lots of news out there, and I want to make sure you're filtering it. So what's going on out there? Well, as far as the United States economy is going, we're definitely slowing. There's no doubt about it. Nothing has changed from the past 2 weeks when I talked to you. Nothing has changed. Data is still getting worse and worse and worse. In the U.S., we're getting closer and closer to a pretty big election, about 4 months away in early November. So that's kind of on the horizon, and that's big because no matter what region of the world you're dealing with, there is government and political in kind of international coordinated efforts to buoy the equity markets. So if you're a president of the United States and you want to get reelected and data is getting worse, well, you're probably going to do everything you can to buoy the stock markets. And we know that buoying the stock markets lately has been as a result of the European Central Bank providing accommodative stance, the United States Federal Reserve providing an accommodative stance. So there's not too much, I think, question about what's coming down the line pretty soon from the United States, which could be more quantitative easing. The markets want it. We know that Mario Draghi spoke today on behalf of the ECB, the European Central Bank. They're going to do everything they can. So Europe is obviously looking to the European Central Bank to make sure that things stay kind of solvent there, that the euro stays intact. So more so than ever, it is a political, it's a government, it's these interventions that can happen at any time, and you must be aware of it. You must trade around it and be able to react to it, whether you're in a trade and then all of a sudden an announcement or a rumor of announcement happens and things change. Then you've got to be able to adapt. Something I stress so heavily is do not overtrade your account, because we know that at any time a market can move in one direction very severely, and we may not know why, and so it can be hard to get out if you say, no, my trading plan is right, I'm not getting out of this. But obviously an announcement can move the markets much longer than you can stay solvent in your position. So keep that in mind. We talk about trading with stops and things like that. Even though there's no guarantees with orders and stops and things like that, at least you can have them in there to work as best that they're supposed to work. But I can't stress that enough, that there aren't any guarantees out there. So that's the fundamental picture. Things are getting worse around the world, but equity markets are doing well, and that's something to be aware of, because as equity markets do well, volatility goes down, and as traders, we're always looking at volatility. So we'll look at that when we move into the technical analysis picture. But the bottom line is, just be aware of these international events that can happen at any time on behalf of governments, International Monetary Fund, and Federal Reserves. They can step in at any time. So trend analysis and moving averages. I talked about this in the recent webinar. So if you haven't seen the most recent webinar from 2 weeks ago, it is live on the IBFX YouTube page. I encourage you to go there. My 20 or so videos are under the Trading in the New Economy tab within the IBFX YouTube page, and it shows trending pairs. So just a little bit about moving averages. They work best in trending markets. I'm not going to spend too much time on the definitions of moving averages. If you're interested in learning more, go ahead and look it up, and I'm just going to show you them as they're applied to the markets. But the bottom line is, there's no doubt about it, the definition of moving averages is they work better in trending markets. There are different kinds of moving averages, simple and exponential. It depends on how they're calculated and what they're measuring. But the bottom line is, for the most part, simple moving averages, if it's a 9-period moving average, will measure the most recent 9 periods evenly. If it's an exponential moving average and it's a 9-period moving average, it will weight the most recent periods heavier than period 1, 2, 3, 4 versus 5, 6, 7, 8, and 9. So exponential weight the most recent data a little bit heavier. Don't get caught up in saying, oh, I had a loser using simple, I'm going to move to exponential. That's not what you want to do. You don't want to be bouncing around. You want to get consistent and use the same thing over and over and over. But the bottom line there, combine with other data. I call it lining up moons. Combine with fundamental analysis, combine with technical analysis, other indicators, chart patterns, things like that. And I think that you'll have a better chance of having some success in the markets, with no guarantees, obviously, but we're not going to just rely on one thing to be the holy grail. It's nice to have a little bit of analysis. I'm not talking about analysis paralysis in 10 or 15 different indicators. I'm talking about just having 1 or 2 or 3 moons line up with your moving average there. So combine it with other data. Don't get caught up with the real finite stuff, which one to use. Have an understanding of it, but main thing is understand when moving averages work best and how that can be in your best interest. Obviously, as a pair breaks out and trends either up or down, that's when a moving average is going to work best. If a pair is trading sideways in a range, you may not get the most out of your moving average and may have to use other indicators. So let's see if any questions have come in so far. It looks like one question's come in. So this is good. Someone just asked, mostly the moving averages that are used seem to be simple and exponential. What about smoothed and weighted? Are they useful as well? And again, that's what I'm kind of saying is the simple is more of your smoothed, all right, versus the weighted would be exponential. But yes, I said simple and exponential aren't the only ones. There are other ones. You can kind of be, abreast of it. But I think what you are aware of it, I think what you just said, though, is most people use simple and exponential. I like to stick to what most people use. There's about 50 or 60 different indicators out there. I don't use all of them because some of them are just, not used that much. I like to use what people are focusing on. Just like when I'm talking with people who are trading stocks or options on stocks, they might be using the TradeStation software here that's now a partner with IBFX. Trade the household names. Trade what other people are trading. Use what other people are using. You don't have to reinvent the wheel here. As I'll show you, if you just understand trends and support and resistance, you don't need to go into lots and lots and lots of fancy stuff. I think you can have a good idea of where there's buying pressure and where there's selling pressure. So very good question. But again, I think it's a good idea to have in the back of your mind when a moving average works best, which is in trending markets, and then which one are you going to pick and why. And I think that if you're going to start to go out to some of these different types of moving averages and really start to fine-tune it, then you're going to have a reason why. But pretty much you can be pretty happy using just the simple moving average or the exponential moving average and using them consistently. That's the key. Use them consistently. So long-term versus short-term, again, these are just suggestions. Some of you are long-term traders and you take advantage of long-term trends in the foreign currency markets. So you could look at the 50 period moving average, 100 period moving average, 200 period moving average, either simple or exponential. And maybe you could put them both on. They're not going to change too much, as far as the simple versus the exponential. The more data you put in, yes, you'll see changes, but on the shorter term, it's going to be very, very close. So the shorter term trader might be looking at a 5 period, a 9 period, a 15 period, a 21 period, a 30 period. I have done other webinars. If you're really, really interested in moving averages, go to the IBFX YouTube page, look for my Trading in the New Economy series, and you'll find other moving average webinars. One of them I talked about using the crossover method, where you use two different moving averages to cross over each other, and that could be a buy or sell entry, an entry strategy or an exit strategy. Keep in mind, moving averages are lagging. The price updates first, and then the moving average updates in reaction. It's not the moving average updates and says, hey, I'm going to be going up or down, you should buy or sell a pair. It's the opposite. The pair starts to move, and then as the prices update, then the moving average updates. So it is a lagging indicator. So just keep that in mind for your risk reward when you're building your trading plan, that maybe a move has already started, then it caused the moving average to update or caused the moving average to cross if you're using the crossover method. So you have to realize you may not be getting it at the exact start of a move. You may be getting it a little bit into a mature move, and you have to decide what your risk reward is going to be using the charts, using your fundamental and technical analysis to say what's achievable. So I'm really, really big on creating trading plans. It's not enough just to use an indicator and say I'm going to get long or short. What else is helping you to say why and where are you getting in, why and where are you getting out for a loss, why and where are you getting out for a profit. This doesn't change for any market you're trading out there, whether it's equities or options or futures, whatever it is, because some of you might be TradeStation clients now listening in on these webinars. It doesn't matter. Moving averages work in all different markets. Once you learn to read a chart and use it well, then obviously you can adapt that to any time frame and any market situation, any trading entity. Let's see. So someone was asking, since the moving average is a lagging indicator, it's not possible for it to detect upcoming spikes. For example, the spike that happened earlier in the day on the Euro USD, what can be used to anticipate those spikes? It's a great question. I think you're talking about the Euro going up all morning. I'm not sure, or basically all day. This had nothing to do with technicals, you guys. This was all fundamental. It was the ECB. It was an announcement overnight from Mario Draghi. So that's what I mean by you've got to know fundamental analysis. That's what last week or 2 weeks ago I talked about, is using fundamental analysis to get you into a trending market and understanding that. So depending on when you came into the markets today, whoever asked that question, you already knew what was driving the price. Now you just had to decide what your risk reward was to get involved in the trade. I trade on the United States and focusing on when New York Stock Exchange opens, so when the American equity opens, and the markets had already gone straight up. The euro already had a big day up. The pound already had a big day up against the United States dollar. I had to decide if there was more upside potential in that day and what was my risk reward, whether I'm going to use a moving average or not. So whatever my trading plan was, obviously you just had to go ahead and know that there was other news out there. So that's what I mean by lining up those moons and paying attention to the fundamental analysis. Fundamental analysis is huge. If you're not doing it and paying attention to Forex Factory and listening to this stuff, it's massive. So let's go live into the charts right now and go ahead and look at some of these. And I'm going to pause while I go ahead and switch my programs, and we're going to go live into the markets. So I talked a little bit about volatility. I just want you guys to be aware what volatility is doing, okay? Volatility here at the top, this is TradeStation's platform. TradeStation and IBFX are partners, so it's a great platform to see equities trading, and obviously if you're trading options on equities. So volatility has been going down, and it's been very, very low. That means for the most part, trading ranges have been smaller. So as volatility goes down, volatility is known as the fear gauge. Fear, uncertainty, anxiety go away. Trading ranges and opportunities go away. So you can still be trading every day, but you may not be trading for as many pips as you were when volatility was much higher. Or you might be trading a little bit less frequently, and instead of 5 times a week, you might be trading 2 times a week. It all depends on what you're looking for, as long as you're realistic and understanding what you can get out of the markets now, given how volatile the markets are. The volatility is the top chart. The bottom chart is the S&P. So they're mirror images of each other. So as fear goes down, the markets go up. So the markets go up, fear goes down. So it's really that the VIX is trading in reaction to the equity markets. So the equity markets went up the past few days. The VIX went down the past few days. Less fear. Hey, the ECB is going to help us out. Less reason to be fearful. Equity markets go up. Volatility goes down. So that's not always to say that trading ranges can't be big, but on average, as volatility goes down, on average, the trading ranges do go down, and we'll be able to see that. But obviously today was a huge day up in the equity markets, and that transferred over into the foreign currency markets. So let me just check back before I jump into the foreign currencies, because you guys know that I like to trade options, equities, and foreign currencies on different time frames. You know that I use foreign currencies for different reasons, not just scalping, but also for what I'd call as an equity protection. Obviously, there's no free lunches out there, so if I think I'm protecting an equity down move, there's no guarantee that my hedge will make money. There's no guarantees in the markets that will, but you know, it will work. But at least I'm trying to find relationships that I think are in play, and I think there's a lot of relationships between different market entities such as equities and foreign currencies. So someone was just asking about the about the specific criteria of the crossover method. What is a specific crossover? So I'm not talking about crossover between the euro US dollar. I'm talking about a crossover on the moving average, maybe a 5 period versus a 9 period. And I'll see if I can draw that up there as we go into the foreign currency market. So I'm just going to switch the application. And I just wanted, I told you I'd show you a couple of different time frames. So obviously the euro US dollar, I've been writing about this in my daily market commentary and on my posting within IBFX's Connect site. So this is a daily chart of the euro US dollar. We know that the euro US dollar has been in a long-term downtrend. So maybe some people are using this moving average that I have up here. I've already put it in. It's the 50-period moving average. That's something that might match someone who's a longer-term trader. So the 50-period moving average is heading down, and look what's happened lately. It's been acting as resistance here. So someone might say every time it comes back up to this moving average, I might get short the euro US dollar because it might be overbought there, put my stop in above it, and get out if it goes above it. They might be willing to risk 100 or 200 pips to make 300, 400, 500 pips as a longer term trader. So this is a 50-period moving average on a daily chart. So that crossover, I could go ahead and put in another moving average. So I go up to my indicators, and I know that moving average works best in trend. So I see under trend that the moving average pops up, and I can just put in a 100 period, and I'm just using the simple ones just as it's defaulted there, and I'll put it in on a blue line there, and now you'll see the 50 period moving over the 100 period. So this is just a quote unquote system. When the 50 period, the red line, crosses over or under the blue line, I go long or short. In sideways markets, you can see that the price isn't doing much, and you get in and out and in and out, and then all of a sudden we trend, and right here could be an entry, and look where the crossover was, down here. The price really started moving down here, but the crossover didn't happen here, so that's what I mean by lagging. You got in at 29, let's say 30. 29.30, you're not out yet. We don't know where it's going to cross the other way, but maybe you're using now the 50 period as your resistance level and kind of keeping an eye on that. There's all different ways to kind of understand and adjust your trading plan, and you can use order types and trailing stops and things like that. But again, fundamentally, we know that something's wrong with the euro region, and it's been going down, and so as long as that happens and continues to happen, maybe we still see down moves. But if you have a winner from 29.30 and this thing is now at 23 or 22 or 21 or 20, you're looking at other reasons where to lighten up, where to put in stops, where to, at least have some trade management. I don't think anyone wants to have a 600 or 700 pip winner go away. So hopefully they're lowering their stops, they're lightening up, they're using other markets maybe that they think are going to go up and stay short the euro US dollar, but they might get long the pound US dollar. Who knows? All different things that you can do, but just using the moving average, you're still in this trade. Just using the moving average crossover, you're still in that trade. You know that this price is going to have to go up for the moving average to cross over the other way. So you know you'll give pips back, but I think that you probably would still have a winner. That remains to be seen what happens, how quickly. If the euro pops in one day, then maybe not, because that's not going to get that crossover to cross the other way in one day. If it moved up 200, 300, 400 pips, it would still take time for that lagging indicator to update. But that's the crossover right there on a longer term period. What about the short-term use of it on a smaller time frame? So that's exactly where I'm going. I told you I'd do a long-term and short-term. Time frames are dynamic, and there may be a lot of whipsaws. How do we avoid these whipsaws? Adding another indicator, which one? So that's exactly it. So there's different indicators, chart patterns. I think that you need to be able to combine fundamental analysis. So let's talk about today's action. All right, so someone was talking about today, the move up, whether it was the pound, the euro, the US dollar got slaughtered. I wrote about it in my market commentary that I'm going to give you a link to. That is on my website, jupiterpeakfinancial.com. That's where I post my daily market commentary. So I don't really start trading until the United States equity markets open up, and that's about 1400 GMT time. So that's right around here. The United States markets opened up. The move happened, not much going on in the American equity session. The move happened in this time frame, 9 o'clock GMT time to, let's say, 1400 GMT time, about 4 hours or so, their morning equity session. And then we kind of went flatlined after that. Well, the equity markets around the world went straight up on the ECB announcement, and then it went very sideways near its highs. So that's what the euro did. It went straight up and sideways. That's why it's so important to understand these relationships between equity markets and when people are speaking in these larger relationships. So here I have a 9-period moving average. That's it, the 9-period moving average. This spike happened on fundamental news, and you might have to say, wow, I might not technically get much today, but I know that fundamentally I don't think that I want to be bearish today, because based on this news, that's a really bullish announcement for the euro or the pound or whatever it is, and a very bearish news announcement for the dollar. So obviously the amount of pips going up, you could still make money shorting the pound today, but we know that the length of move in pips to the upside was much bigger, and that's what a trend is. That's a severe trend up with very, very low retracement. So you didn't have much time to get on this uptrend. If you weren't on in the beginning, it was moving 30 pips, 40 pips at a time and just going up and up and up and up and up, and that was it. And then it finally sat back a little bit. So even though we know that moving averages work better in trending markets, this wasn't technical. This was more fundamental, and it may not have gotten us a chance to get in. I could throw on a shorter-term moving average, maybe one that matches this 15-minute chart even more so. I could put on a 5-period moving average, and I'll keep it in aqua. And there's your crossover right there. And maybe every time you said, this is such a bullish fundamental event, the ECB is helping out equity prices, and when equity prices go up, normally the euro goes up as well. There's that relationship that you know about because you're paying attention to it. And there's that 5-period moving average. Every time this thing just sat right back down to that aqua line, that blue line, that was a buying opportunity. So that's the point, is fundamentally it was so bullish that there were very little retracements. I use Fibonacci retracements. Well, this one didn't retrace at all. You couldn't put a Fibonacci retracement on this chart at all, and that's something to understand. Hey, this market can't go down. They love this euro today. They're buying but they're buying it so fast that today is a momentum trade. I've got to get on, and maybe I use a very, very, very short-term moving average like the 5-period and say, hey, that's my entry. I'll risk 5 or 10 pips below it as my stop, and as long as it bounces off it and goes 10, 15, 20 pips above it, that's my winner. And you could have done that multiple times today. That worked out. So we just had to be aware of what was driving things today, and that's a fundamental event. And that's big because we're getting, as I said at the beginning of tonight's webinar, we're getting fundamental events out of governments all around the world to drive these markets on a daily basis. We've got to be aware of it. So I'm a big guy that uses Fibonacci retracements in conjunction with other things. there, I wouldn't have been able to use it today, but I would have understood that and said, hey, this thing isn't retracing. I've got to be very careful if I want to be a seller of the euro today because the markets are going up so fast and so violently, and they're not sitting back that much. They didn't really sit back until here, but come on, that was only a very small part. I could draw the Fibonacci for you if you'd like, because I love drawing them. And here's the move that started on the way up, and it went up to about here, let's say. So it didn't even retrace 23%. That's not steep. So maybe we continue to go up tomorrow. Who knows? All depends on what equity markets and other announcements and things like that, because tomorrow is a long, way away from right now. But that's at least price action is telling you this thing is not sitting back, and the 5-period moving average, may have been something to keep an eye on. So a short term, as I said, a short-term trader uses a 5-period, a 9-period, a 15, 21, 30, something like that. So you might not have all of them on it, but whatever you have on, at least you had guidance to say, hey, it's not sitting back to the 9, it's not sitting back to the 21 for sure, it's not sitting back to the 30 for sure. So I'm just going to kind of keep an eye on this, and if I don't get a trade based on my moving average and what I use today, that's just fine. At least I didn't do anything that was out of my plan. Stick to your plan and what you use as far as your reasons to trade. Okay, so that's a long-term and a short-term, something that's happening long-term fundamentally, the euro-US dollar going down, and something fundamentally in the short-term, the pound going straight to the moon today against the United States dollar. Those are two looks using moving averages, seeing a little bit of crossover as well. So I really don't think there were any really whipsaws today at all. I think that there was just one move up, and that was basically it. I use the crossover method, but sometimes I confuse due to different period times. The crossover is not consistent. So, and again, that's what I'm saying is I don't think that you guys should be switching your periods. I think you've got to get consistent with 1 period or 2 periods. If you're using the crossover, pick 2 and stay with that. But it all depends. I don't know if you're a short-term or if you're long-term. Make sure you're using the right period moving averages for which type of trader you are. The 100 moving average and the 50 moving average, better on longer time frames? I think so for sure, but some people might use the 200 period moving average is kind of institutional. That's what the big investment banks use. And so a lot of equity traders and option traders watch the 200 period even though they're on a shorter time frame. So it depends on, again, exactly what you're looking to do with it and what time frame you're trading. I don't know what you guys are doing as you're asking these questions. So I definitely think that the moving averages must match up with how long of a time frame you're looking at. That's why I suggested to you guys, these are just the suggestions. Let me get this back to the right screen here. Let me get this back to the slideshow. So these are just suggestions. Longer term traders, and a lot of people don't know what type of trader they are in foreign currencies. I think that longer term traders should be able to risk 200, 300, 400, or 500 pips. Some people, long-term traders, think they should only be risking 20 or 30 pips. So make sure that you understand what really type of trader you are. Short-term traders probably are only risking 5 or 10 or 15 or 20 pips, and they're looking at a very short-term period moving average, the 5, the 9, the 15, the 21. So those are just my suggestions. If you have questions, if you don't understand how many pips you should be risking for your account size, because I think this is very, very big. A lot of people risk way too many pips for a small account size. Some people think that they're day traders and they don't even have time to be day traders in foreign currencies. So people are confused to start out with is what type of trader they should be. Then they're trying to use moving averages on the wrong time frames, and they're not even able to use those time frames maybe effectively because they're not able to be in front of the markets as much as they need to. I do what's called an engagement interview. You are the system. I think that you have a better chance of success if you understand who you are and treat the markets realistically, if you understand what your personal trading personality can adjust to and can handle. So if you have questions on that, it's a Skype phone call, or it's a phone call on using a mobile phone for about 30 minutes. I ask some pretty direct questions, and I kick back a nice concise summary of what you can achieve given my 15 years in the markets in various time frames and my 4 or 5 years of consulting with Jupiter Peak Financial. And then you get at least a clear, concise, unbiased opinion of your situation. Whether you want to use it or not, that's up to you, but at least you get an understanding of what I think is achievable for you. So if you want to set that up, please take advantage of it. That's basically what we're trying to do here at IBFX and at TradeStation, is make sure that our collaborators are providing good content and something that, following up with you if you have those questions so that you guys can get that information and use it a little bit more kind of honed in and grounded on your individual situation. So please take advantage of it. It's free. It's no obligation. I encourage you guys to take advantage of it if you have further questions on that. So to review, I gave you my opinion of fundamental events and the macro and micro events, the ones in the United States economy where we've been getting worse data out of the United States economy, but that data that's poor is actually a positive for equity markets and can be a positive then for one of the different foreign currency pairs out there, depending on what the equity markets are doing. So take advantage of those relationships that are intermarket based on understanding fundamental events out there, ECB talking, Federal Reserve talking, Bank of Japan, Bank of England, all of that big macro stuff. Trend analysis, like I said, the webinar from 2 weeks went deep into trend analysis. Today we added in moving averages, a little bit of the crossover as well, but most importantly, understand which time period of moving average fits your strategy, fits your time frame, fits your personality as a trader. Talked about your opportunity, so if you have any questions and want to get dialed in a little bit more on who you are, please reach out via email. How you can follow up with more information, I'll be talking in 2 weeks with another webinar on behalf of IBFX, so please catch up on that. The main topic is not to be determined anymore. It will be on stop losses. A lot of you have been asking about stop losses, how to use them, how to implement them. We will talk about them and make it well known. Stop losses do not guarantee anything, but they can help to keep you around for a lot longer by limiting your losses. They don't guarantee where you get out, but they can definitely be a better tool than not having them at all and just leaving things to chance. So we'll do the same thing, fundamental analysis, technical analysis, and then the main topic, which will be stops. Education and recordings, as I said, IBFX is providing you great education. Use their website. I post every day, almost every day, some daily market commentary. I posted today at dailyforextradingedge.com. I also post on my own blog, but I've just updated that. So that is jupiterpeakfinancial.com, where you can learn about me, and you can also see all of those posts as well. Please go to YouTube. Please go to the IBFX Interbank FX YouTube site, where you can see 24 of my videos, and a lot of them focus on moving averages. So please be aware of that. And then on a daily basis, I post almost every day about what I'm seeing in the markets, in the Forex markets, and these intermarket relationships. So please be aware of that using the IBFX Connect social site, following me under the Locals Take. Let's see if there are any other questions coming in to finish up here, to wrap up. So it looks like I've gotten all of your questions answered. Hopefully that helped you understand what moving averages and time frames might be closely related to your trading strategies and trading style, and to know that they aren't the holy grail, to know that you have to understand and basically use them with other analysis, mainly fundamental analysis, and then other technical analysis, understanding how to read the charts, support, resistance, understanding moves where they're not sitting back, just like today we saw the pound just go up and up and up and not sit back much, but understanding chart patterns, understanding other tools, other indicators, moving averages, just like Fibonacci's. If you can line up a couple moons, as I call them, I think that you'll be well served. But the bottom line is trading plans, you guys. Trading plans, trading plans, trading plans. Reasons for entry, realistic stops for losses, realistic stops for profits, based on the charts. I can't stress that enough. Based on the charts. Don't just guess. The charts are your guideline. They're your flow chart. They tell you what to do. Use the charts to help you create a trading plan. Until 2 weeks from now, please follow me on the Daily Forex Trading Edge and on the IBFX Connect site. And if you have any questions, you guys know how to follow me. My email is right back here. Please follow up. I'd be happy to talk to you and provide time for you. Happy trading, and invest intelligently.